Work hard and save your money. Come on, we've all heard that a million times, right? For decades, that's been the golden rule of personal finance. You know the drill. Put your money in a safe place, watch it grow, and you'll be set for life.
But what if that advice is completely outdated? What if it's actually a dangerous misconception now? What if I told you that in today's economy, blindly stuffing your cash into a savings account is one of the fastest ways to actually get poor? It sounds crazy, I get it. You look at your statement, you see the balance going up, but somehow your actual financial power is going down. So that brings us to the real question we need to answer. Why is your bank account secretly shrinking? Okay, let's get right into it. The culprits here are two incredibly powerful and often invisible forces that are working against your cash 24/7. Let's call them what they are, the silent thieves: inflation and taxes.
Now, inflation isn't some new problem. It's a relentless, long-term machine. I mean, just look at this. Since 1914, the US dollar has lost almost 97% of its value. What you could buy for $100 back then would cost you thousands today. That's not just a history lesson, folks. That's a serious warning for the money sitting in your account right now. And that warning is getting more urgent by the day. The OECD is projecting US inflation to hit 4.2% in 2026. This isn't some abstract number in an economics textbook. This is the real-world rate at which your hard-earned cash is literally set to evaporate. And this chart, wow, it really puts the problem into perspective. Your average savings account might be paying you a measly 0.5%. Now, put that right next to a 4.2% inflation rate. The math is brutal. You're losing a significant chunk of your purchasing power every single year, guaranteed. So how do we actually calculate the damage over time? Well, there's this simple but incredibly powerful tool called the Rule of 72. It's a quick little formula that helps you visualize just how fast inflation is eating your lunch. And the calculation couldn't be easier. You just take the number 72 and divide it by the inflation rate. So 72 divided by that projected 4.2%, and you get a number that's just, well, shocking. A little over 17 years. Just let that sink in for a second. The money you're so diligently saving up, maybe for retirement, maybe for your kids' college, its buying power will be cut in half in just 17 years. That's not a lifetime away. That's like a blink of an eye in financial planning terms. But wait, it gets worse. The assault on your savings doesn't stop there. Inflation is the first punch, and taxes are the 1-2 knockout. And here's the truly insane part. The government taxes you on the tiny bit of interest you earn, while inflation is actively destroying the real value of your money. You're literally paying taxes on a financial loss. It's wild. Now, I know what some of you are probably thinking. You're feeling pretty smart, you're ahead of the curve, right? And this brings us directly to the most common objection I hear, which I like to call the high-yield savings myth. You're probably saying, hold on, my high-yield savings account is keeping up just fine. It's paying me 4, maybe even 5%. And you're not wrong, that is way better than the national average. But does it really solve the core problem here? Here's the hard truth. Even at its best, a high-yield savings account is just helping you tread water. You're essentially matching inflation, which means you're only preserving your purchasing power. You're not growing it. And remember, that's before the IRS comes knocking to take its cut of that interest. So let's be crystal clear about this. Running in place for your entire life is not a financial plan. It's financial stagnation, just dressed up to look like responsible adulting. You're working your tail off just to stay exactly where you are. So if saving isn't the answer, what is? Well, to figure that out, we need to stop thinking like a saver and start looking at the wealthy's playbook. Let's dig into how you can actually grow your money. It all boils down to a fundamental shift in mindset. Look at this comparison. The saver is always on defense, trying to protect and hoard their cash. The investor, they're on offense. They deploy their money into assets, and their goal isn't just to preserve, it's to multiply and stay way, way ahead of inflation. You see, the wealthy see cash not as this precious asset, but as a liability that's losing value every single day. So they don't hoard it, they put it to work. Historically, the stock market has returned about 7% after you even account for inflation. They invest in things that grow: stocks, real estate, businesses. Their money is always in motion. Okay, this is all great in theory, but how do we make it real? How do we make it actionable?
Let's break down your new game plan so you can make that critical shift from saver to investor. Here it is, your new 4-step framework. First, stop protecting and start deploying. Get your money off the sidelines and into the game. Second, you have to invest in inflation-beating assets. We're talking about things like stocks or real estate that have a long track record of growth. Third, minimize your taxes by mastering accounts like a Roth IRA or a 401k. You've got to legally shield that growth from the IRS. And finally, number 4, build income that grows. Focus on creating income streams that can increase over time, not just protecting a static pile of cash in a bank. You know, we've all been taught to fear the ups and downs of the market, but the real lesson here, the core message is this: the biggest risk isn't losing money in the market. It's the guaranteed silent loss of your purchasing power happening right now in the bank. So I'll leave you with one final question to really think about. You work so hard for your money. You sacrifice for it. I want you to take an honest look at your strategy and just ask yourself this: is my money working as hard as I am?